Following our recent articles about raising the Social Security taxable wage cap, we have heard a reasonable concern from business owners. Employees pay 6.2% of their wages into Social Security, and employers contribute another 6.2%. If Congress raises the wage cap above its current $184,500, employers would have to contribute more on salaries above that amount. That is true. It should not be brushed aside. But business owners should consider the broader economic question. What happens to their businesses if Congress chooses benefit reductions instead? Raising the retirement age reduces lifetime Social Security income. Allowing the trust fund to become depleted could produce a much larger and more immediate reduction. Either approach removes purchasing power from the customers American businesses depend upon. For most businesses, that broader economic cost may be considerably greater than the additional payroll cost associated with a handful of highly compensated employees. The Social Security wage cap applies to individual earnings, not household income. A married couple earning $110,000 each may have household income of $220,000, but neither worker earns enough individually to be affected by raising the current cap. An analysis of 2024 census earnings data indicates that approximately 60,000 Oklahoma wage and salary employees earned more than that year's Social Security cap. That was roughly 3% of Oklahoma workers. Approximately 97% of Oklahoma employees, and the employers who hire them, would not be directly affected. Even when an employee earns more than the cap, the additional contribution would apply only to compensation above it. An employer with a worker earning $200,000 would pay approximately $961 more. At $250,000, the additional employer contribution would be approximately $4,061. That is a concentrated cost affecting a relatively small number of highly compensated positions. Benefit reductions are different. They reduce purchasing power across nearly every industry and community. Republican study committee budgets have proposed raising the Social Security retirement age or indexing it to life expectancy. Earlier Republican study committee plans proposed increasing the age to 69 or 70. Raising the full retirement age from 67 to 69 would leave workers with two choices. They could work 2 additional years to receive the benefit currently promised at 67. Or they could retire at the same age and accept a permanently smaller monthly check. Someone retiring at 67 after the full retirement age increased to 69 would receive approximately 13% less each month. Someone claiming at 62 would receive approximately 14% less than under the current schedule. Supporters may call that a retirement age adjustment. It is still a benefit cut. The assumption behind the policy is that people will simply work longer. Some will. Many will not be able to. A lawyer, executive, or office worker may be able to remain employed for 2 additional years. That can be very different for a construction worker with a bad back, a nurse who has spent decades lifting patients, a mechanic with damaged knees, or an oil field worker whose body has absorbed 40 years of physical labor. Those workers may claim Social Security early, not because they want a longer vacation, but because continuing to work is no longer realistic. They would then receive smaller monthly checks for the remainder of their lives and less total Social Security income during retirement. That matters especially in Oklahoma, where life expectancy is only 73.8 years. The retirement age proposals would be phased in and would not create an immediate 20% reduction for every current recipient, but they would gradually reduce the retirement income of future customers. A second danger is much closer and potentially much larger. The Social Security Retirement Trust Fund is projected to be depleted in late 2032. According to the Social Security trustees, continuing revenue would then cover approximately 78% of scheduled retirement benefits, a 22% shortfall. The Congressional Budget Office examined a somewhat different payable benefits scenario and estimated that benefits could be reduced by an average of 28% from 2033 through 2036. That would remove approximately $2.7 trillion from recipients over 5 years. Even a 20% reduction would eliminate approximately $445 billion in annual benefit payments, roughly $400 billion to $445 billion in disposable income after accounting for somewhat lower income taxes on benefits. That is not money sitting harmlessly in a government account. It is money that would no longer be spent on groceries, utilities, prescriptions, automobile repairs, restaurants, clothing, home maintenance, and other consumer goods and services. The loss would move directly through the American economy. The Congressional Budget Office estimates that the sudden benefit reductions following trust fund depletion would weaken consumer demand and leave real gross domestic product approximately 0.7% lower in 2033 than it otherwise would have been. That represents an estimated $225 billion to $300 billion in lost economic output. Business owners are right that raising the wage cap would increase their cost of employing some highly compensated workers. But doing nothing is not free. Raising the retirement age is not free. Cutting monthly benefits is not free. Those alternatives shift the cost onto retirees and then onto the businesses that depend on retirees as customers. An across-the-board payroll tax increase would raise the cost of hiring every worker. Raising the retirement age would reduce lifetime benefits for people who cannot continue working. Allowing automatic benefit reductions would remove hundreds of billions of dollars from consumer spending. Raising the wage cap would concentrate the additional contribution on approximately 3% of Oklahoma workers and only on compensation above the cap. That does not make the employer cost imaginary. Puts it in perspective. One approach asks employers to contribute more on a small portion of high-end payroll. The alternatives reduce the spending power of customers in nearly every Oklahoma community. Businesses need employees. They also need customers. Protecting Social Security protects both. Follow the money at wlangdon.substack.com.